All right, everyone. Thank you so much for joining us today. We are super excited. My name is Hassan Sheikh. And before I begin, let me just apologize about the mouse clicks. It is not that I am angry. Amar has told me that they seem extremely aggressive. The reason the mouse clicks are loud is because it's right next to my microphone. So my name is Hassan. I lead the business development and marketing team at SmartCrowd. And of course, we'll introduce the CEO and founder as well, Sadiq, who's going to be presenting today. Today's seminar or session, it's really more like a live tutorial. And it's effectively, you're going to walk away with learning how to analyze a residential property here in Dubai. So it's a very hands-on, practical tutorial. We recommend that you have a pen and paper, a notepad next to you, because I'm sure you're going to walk away with a lot of really cool tools, and as well as a Excel model at the very end, which you can plug and play yourself and analyze a property on your own. Before we begin, a couple of housekeeping items that I would like to mention. Number one, if you have any questions throughout this session, please feel free to ask your questions in the chat. I will be moderating them, and I will be picking them out as and when they are relevant, so that as Sadiq is going and walking you through these various different tools and different features and numbers that he looks at when he's analyzing properties, I can ask him those questions right then and there, and so it's a lot more interactive for all of you. That's number one. Number two, anything here is not investment advice. So I'd like to just clearly outline that we're here just to provide a service, give you some value-added content, and share with you how we think it makes sense in terms of analyzing properties. But before making any investment decision, we do highly recommend that you either do ample due diligence on your own or that you seek the advice of a professional. With that said, I would like to introduce Sadiq. So Sadiq, wherever you are, please do turn on your camera so that we can introduce you to everyone here. Sadiq, of course, as many of you would know, is the founder and CEO of SmartCrowd. Started SmartCrowd out of a personal necessity. A few years back, Sadiq was in the market to purchase or was looking to invest in residential properties, and the price points were a bit too high, and he didn't want to take a lot of concentration risk. And so, long story short, decided that there must be a better way to do all of this. And today we have, SmartCrowd, which is the region's first and only investment property platform that allows you to invest in real estate via crowdfunding model. So go ahead, Sadiq, take it away.
Well, thank you for that kind introduction, Hassan. Just to reiterate, not investment advice, but put it all on red. Just kidding. Get used to those lame jokes throughout the evening to keep this thing entertaining. Well, thank you, Hassan, very much. Excited to have all of you over here. If you have been attending our monthly webinars, I hope you have learned to appreciate the content that we provide and the direct conversation we like to have with everyone. As part of SmartCrowd mission is not only to make real estate investing accessible, but we also want to make people better investors and educate them along the process. So keeping that in mind, in the last few seminars, we had a lot of questions being asked about how we go about evaluating opportunities and so forth. So what we decided to do was do a webinar to walk you guys through in terms of what kind of things you should be looking at when you're evaluating a real estate investment opportunity, what kind of free resources that are available on the web that you can take advantage of today, and then also at the same time get a glimpse of what we at SmartCrowd do when we are evaluating opportunities before we qualify them to put onto our platform. I've gone through the participation list over here, and I see many of our investors are over here. So I think it's going to be a good opportunity for you guys to see all the work that goes behind the scenes, and many new people that are joining probably out of curiosity, wanting to learn and get a piece of the action, as they're probably hearing in the market from a lot of people, etc. There's buzz in the real estate market, in Dubai real estate. It's alive again, and just wanted to sort of figure out how to get started. So you'll learn a lot of different things in this webinar. Feel free to please do ask questions as I'm going along, but I have a tendency of speaking very fast and trying to connect many different things, because obviously I do this on a day-to-day basis. So a lot of things that might be very common to me or given to me might not be for everyone else. So please do post a question. Hassan will be monitoring the chat, and he will interject and ask relevant questions at appropriate times. So let me see if I can share the screen here and get started. Hassan, can you make me host so I can share my screen, please?
Yeah, you're
98, come on, 2 more. Somebody call their friends, 2 more people, tell them to get on. I want to get a century here. We got 98 people, 2 more. Come on, I'm not starting until we get 100. Somebody has to call their friend and ask them to just join in, or use your mobile from a different connection to make it 100. I ain't starting. 99, come on. There we go. All right, we can start now. All right, sorry, those are my lame jokes, just to keep everyone excited. Can you guys see my screen? Yep, perfect.
Yeah, you're good to go.
All right, wonderful. Great. So evaluating real estate investments in Dubai. Just cannot get this out enough. This is not investment advice, just some tools for you to understand how to evaluate investment opportunities, do your own due diligence. And the whole idea of this webinar is to equip you so you can do your own homework on opportunities in the future as you decide to
I'm just going to
invest.
interject here. I think half of your screen is showing up, at least for me it is. So before anyone else complains, can you just check that your full screen is visible? There you go. It's fine for me now.
All right, here we go. I don't have my dual screen today, so I'm struggling a little bit. You guys can see, right? So
yes, you're good to go. Yep.
Cool. Awesome. So just as a recap for people that don't know me, I'm Sadiq Fareed, founder of SmartCrowd. I'm a trained chartered accountant, CFA charter holder. Most of my experience in my life, I've spent mostly in big 4 accounting firms in corporate finance in 3 different countries. And I've been working on SmartCrowd for the better part of last 3 years. So we're just going to dive right into it and start off talking about why invest in real estate makes sense. So just briefly, for starters, it's hard asset investing, something that is tangible, you can touch and feel, which is great. Second, real estate, one of the key attributes of real estate is, especially when you invest in rental income properties, that it provides you regular cash flow that can be used in various ways that you can use to subsidize your lifestyle. You can use that to compound your investment and essentially help grow your wealth. The other element of real estate is it's not just the asset that provides you regular income, it also appreciates over time in value due to inflation or other attributes of it. It's a great well-generated wealth preservation. So if you look at all the people, wealthy people and people that do proper financial planning, it's a great asset to have within a portfolio that it can be accumulated over time and can be passed on generations as well too. And most importantly, it allows you to diversify your investment portfolio from other traditional asset classes such as equities and bonds that you traditionally invest in. Real estate provides you a different kinds of diversification, different kinds of risk return profile. So you have a well-diversified portfolio to protect you from any economic shocks. Some things to consider when you are investing in real estate. It's not a vehicle to get rich very quickly. You're not going to become a millionaire overnight. And direct real estate investing is a very active management thing, and then you can expect a lot of unexpected expenses such as maintenance and so forth, and dealing with tenants or vacancies, etc. And it will put you out of your comfort zone and test your boundaries, which is okay. It's fine. Doesn't mean it's difficult. You should avoid it. It's just nature of it, but it's very rewarding on the other side of it. Investing in real estate is almost like hiking a mountain. When you're going up the mountain, you can see the top, but the trail to get there is not necessarily very clear. But every step that you take, it becomes a lot more clearer. And real estate investing is similar to that. It won't be easy as you get started, but once you get started, you will learn, you build your network, you figure out how things work, and you will get better at time and become a better real estate investor over time. But before you get started, it's very important for you to establish your why. Why are you investing into real estate? Is it to supplement your income? Is it to replace your regular income? Is it to give yourself a bit more income and more time with your family and friends, etc.? Because your job is taking too much of your time trying to make that earning. Maybe you can switch into a different job and supplement it with some side income coming from real estate. It could be your side hustle, or you want to go back to school. It's very important to understand what that why is, because that will dictate, what kind of investments you're going to look at and how you're going to evaluate those opportunities, as long as it meets your criteria. Because without establishing your criteria, you're going to be like our little friend Joey over here, who's always so confused, right? Because you will see lots of opportunities and you won't know which ones make sense for you because you don't know why you're investing them in the first place. So it's very important for anything that you do, whether it's real estate investing or investing in general, very important to put down your why and have a process in place so you can evaluate your decisions underlining that why, the reason that you're trying to invest in real estate or any other asset class for that matter. Other things to consider is obviously real estate requires a lot of funds. You typically need a lot of money to invest in real estate because real estate is not cheap. Even the cheapest properties in Dubai, require a couple of thousand dirhams, or at least a sizable chunk to put a down payment. Or you can always use a platform like SmartCrowd, and we can talk about that a little bit later as to how SmartCrowd allows you to invest with little money, with money that you can afford to invest in real estate without necessarily having hundreds of thousands of dollars to invest in it. But more importantly, real estate also requires a lot of time and effort. Time and effort, first and foremost, educate yourself. So being here today in this webinar is very important. This is an investment in yourself, trying to educate yourself in terms of what kind of things to look out for. A lot of these things might be common sense and you might already know. So it's also always a good reminder to help you stay on that path of always educating yourself. That's the best investment you can make. Second, there's a lot of time and effort required to find the right opportunities, the right areas, and then you need to do your homework in terms of analyzing those opportunities, because anything good takes time, and you need to put the time and effort into it. Nothing comes easy. Or you can use a platform like SmartCrowd that can enable or help you in your journey, in your process, by doing a lot of the homework on your behalf and providing you everything in one place where you can reduce a lot of your time and effort. And that's one of the things that we do offer as a service, not among just accessibility, but also convenience of it in terms of what we offer.
Sadiq, just one thing. Are you on slide 5? Just want to confirm that some people seem to think that you are stuck right now in terms of your presentation, or are you actually showing slide 5?
I am showing slide 9.
You're on 9. Okay, well, we were stuck on 5 for some time. So I think, yes, that's what's happened. We've missed all your amazing GIFs.
No, you missed my GIFs?
Yeah.
Well, there is my Joey friend. So I probably feel like an idiot making a reference to Joey and you couldn't see Joey. So maybe I'm confused and the GIF is playing the joke on me now. So that was by design. I wanted to confuse everybody, and I think mission accomplished. So slide 9. You guys can see slide 9?
Yes, we can. Well, I'm on. Yeah, 9. I can see that.
Okay, cool. Maybe I'll change the. All right. Again, I guess another relevant GIF of having patience, and all good things come to those who wait, just like this presentation, working out the quirks. But the idea of this GIF was to make the point that real estate takes time, patience. You need to put an effort into it, and you will see the results of it. And patience is the key when you are investing in real estate. So these are some of the basics things I wanted to get out of the way before we started looking at specifics. So what essentially you want to do is you want to build yourself a toolbox that will allow you to help you with your decision-making process. Because without having a toolbox or a set criteria, it's going to be very difficult for you to evaluate opportunities, because you're going to be inundated with lots of opportunities and you won't know whether those opportunities fit within your criteria and what's your criteria for evaluating those opportunities, because you might be presented with multiple options and you need to have a process to figuring out how do you compare those various options, because you could have options in different areas, in different countries, different types of real estate, etc. And you need to have some level of mechanism to put them all on the same level field to compare and decide which ones make sense for you. So we're going to spend a lot of time on this toolbox and what's included in toolbox and how you go about building those set of criteria. It also allows you to be objective in your approach and not be very subjective and lured by people's opinions and so forth. It's very factual, data driven, all based on numbers and facts and not emotions. And that is very important when it comes to investments. You want to be as objective as possible and use the facts and data that is in front of you to make decisions. So what's included in this toolbox? There's various aspects of it, and this is not an exhaustive list, but it's a good starting point for you guys to consider all these different varying factors that you can start off with in your toolbox, and then over time you refine this and improve on it and learn from it and add things, remove things as you evolve as a real estate investor. So for me, the most important thing, you've probably heard this a lot when it comes to real estate: location, which is true. But for me, as a real estate investor, for me, the number one thing is cash flow. Location for me comes second. Cash flow is the king. Cash is king. Because what cash flow does, it allows you to make sure you have holding power. And holding power is a very important concept that we talked about in our last webinar, is that you want to be sure that you can sustain your investment through various cycles and not get desperate at the worst possible time. And having sufficient cash flow being generated from your investment ensures you have the holding power, so you have all the leverage when it comes to your investment and you're not putting yourself in a situation where you are forced to make the wrong decision. So cash flow is important, and obviously cash flow positive. Generating cash flow is important. It's making sure it's covering all your expenses. If you have mortgage on it or any debt on it, it's covering all your debt, and it's allowing you to build enough reserve from that investment that for whatever reason, if the property is vacant for a long period of time, something happens, that you can sustain that investment because you have built a healthy reserve. And then what you want to do is you want to stress test that cash flow, right? By changing variables. What are the key variables you want to look at? What happens if my expenses go up? How does my cash flow get impacted? What happens if the rents come down, right? What happens if the interest rates increase if I have this property mortgage? What are the key 5-6 key variables are? We'll talk a lot about that when we go to the Excel model in terms of actually playing out with an example. It's very important to do that because you want to see how much margin of safety you have within your investment. Because if you're on sort of fine line, then it makes it very challenging for you to sustain that investment over a period of time, and you can get yourself in a lot of trouble on the first hiccup of that property. The other things that it's important to look at is the serviceability of that unit that you're evaluating. What do I mean by serviceability? Serviceability is how easy is it to service that apartment or that unit, meaning how easy is it to rent if it becomes vacant? How easy is it to sell if I need to liquidate it? What is the occupancy rate of that building, that unit, that tower, that area? Is there demand increasing in that, etc.? And how many transactions are taking place in the building, in the area, and so forth. Because what that does, it gives you a sense of how easy it would be for me to manage that property. Will I be able to rent it if the tenant leaves? Will I be able to sell it if I need liquidity quick, etc.? So that allows you to sort of score that serviceability criteria high, because it provides you that flexibility. And the way you build your toolbox is you put different scores, different weightings to come up with the overall score to make your decision to invest or not to invest. And you can tinker with these weightings, etc., over time as you get more comfortable with the different criterias, and you understand what criterias are more important than others. Not all criteria should be equally weighted. And that's what we do at SmartCrowd. We have a scoring mechanism where we look at different things. Within the cash flow, we have different components broken down, and we have different weightage and scoring system to come up with the overall score on the investment. Moving along, the other things you want to concentrate and focus on is the supply-demand dynamics. It's a very sort of a headline topic, supply-demand, talked about a lot over the last few years. Everyone talking about, oh, too much supply in Dubai, etc., which very well be true, but you need to understand, you need to move away from the surface and go into the data and really try to understand what does that mean, right? Having a lot of supply in an area where there's no demand is obviously very bad, but having a lot of supply in an area with a lot of demand is not so bad because the supply is being met with the demand. And having an area with very little supply with a lot of demand is actually very good because then there's less properties, etc. So there's more pressure on prices moving up rather than moving down. So it's also important not to just look at what is historical and what's in the present, but also have a forward looking, because you're not investing for yesterday or for today, you're investing for the future. So you need to look at what's going to happen in the future. Where is the supply trend? Is the supply trending up? Is the supply trending down? What's happening to the demand in relation to that supply? That is very important to understand, because without that, just looking at a very high level thing, supply, too much supply, you might end up making the wrong decisions in the wrong areas. And it's also not okay to just look at overall supply in the particular area. You want to be breaking it down and looking what kind of supply is coming into the market, right? Is it 2 bedrooms? Is it 1 bedroom? Is it studios? Is it villas, right? Because that will help you understand what sort of units you want to focus on in terms of where there's limited supply and where is the demand for those type of units. You also want to look at demand from a population perspective. Where is the population migrating within the city? And there's lots of information available on the web that you can do. There's lots of hacks that you can look at. Dubai has an open data source now that you can look. It's sometimes very difficult to find, but one of the things that we try to find and where we can get access to is DIVA connections, right? So if you see connections increasing in a particular area, we see a lot of demand, a lot of people moving into that area, or there are a lot of disconnections in the particular area. That gives the sense a lot of people are moving out from a particular area. The other thing we tend to do from time to time, not for all, is look at Google traffic, right? So, during rush hours or the busy times in the morning, in the evening, etc., go on Google and look at the live traffic. That will give you a lot of insight in terms of where do people live, where are people commuting to and from, right? And that shows you how much demand is in a particular area. And these are all factual, right? So you're not relying on people telling you something. You're actually looking at hard data to give you a sense. And that doesn't mean you just go to Google one day and you look at it. You do your homework. You go every day, you look at it, or a period of a week or 2 weeks, and you record it, right? And that'll give you sort of a sense in terms of what's happening. Right now you don't have the ability to look at Google traffic, historical trends, etc. That data is not readily available. So you got to do this hard work by going in yourself and checking out these and things, so forth. And we do this from time to time, particularly when we're looking at a new area that we don't have much knowledge of. We try to get a sense of it, etc. Just to get a sense of where is the demand, what kind of demand increase do we see, what kind of amenities are around that. And we'll talk about that a little more in the property characteristics. So once you have these elements factored in, then you start looking at from a return perspective. Right? So cash flow is one element and the return is another element, because you want to make sure you're putting some capital at risk, right? Meaning you're putting some money investing in the property, that money is at risk, right? Investing is essentially managing your risk, right? So you're putting that capital at risk. You want to make sure you're getting rewarded for taking that risk. So the return on your money has to compensate for the risk that you are taking. So it's important to evaluate the returns on your investment. Is it in line with the market? Am I getting a better or worse off return? How does that compare to other opportunities that I have? and trying to understand the risk dynamics of those other opportunities and making sure that the risk is comparable, the return is comparable to that risk, right? So for example, investing in a place like International City versus investing in a place like Palm, and if both are giving you 5% return, you should be able to understand that, those are two very different assets having very different risk profile, and one is riskier than the other, and it should provide you with a higher return than the other, right? Otherwise, comparing them both at 5%, you'll be lost. You'll be able to make that decision. It's very important to understand the risk return dynamics of that. And we'll talk about returns, what kind of different returns there are. But it's also important to understand and not look at absolute numbers, because a lot of people talk about, oh, buy a studio for 200 or 300 or 400,000 dirhams. Great, fantastic. What's the size of the studio, right? Is it a 300 square foot studio or a 500 square foot studio? Looking at absolute numbers means absolutely nothing. You want to drill it down, look at price per square foot, because then you can compare two properties. Because someone say, hey, buy this studio for 400,000 dirhams or buy this studio for 400,000 dirhams, right? One is 700 square foot, another one is 300 square foot. So you can figure out what the price per square foot is, and that'll give you an idea as to what's a better opportunity, because you can compare apples to apples in that scenario. And then also trying to understand the cycles of the market, right? Real estate, historically, all over the world, real estate tends to, over long-term, increase, but during that period, there are cycles, up and downs, right? So you want to understand where you are in that cycle, what is your upside compared to your downside, and understand what's the evolution of the price when you're getting in. You can never time the market. It's very difficult to time the market, but you can control the time you spend in the market. And that's why it's so important that you make the right decisions, so you spend the most amount of time in the market to maximize your returns.
Sadiq, on that point,
Yes.
You said, you can't really time the market, which is absolutely correct. I think a lot of people are wondering, where exactly are we in that cycle for the Dubai market as it stands?
Yeah, so I'm not the one to be Nostradamus and make predictions, right? But, I'm a relative guy, right? So relatively speaking, if you look at the cycles, we've been in a 6-year bear cycle. We were seeing.
So a bear cycle means exactly what?
Sorry, bear cycle means prices going down, right? Sustainably going down. That's a bear. Bull cycle will be prices are going up, right? So bear is negative, bull is very positive. Someone to say bullish, I'm bullish, meaning I'm very excited for the future that I'm going to make a lot of money.
Right.
Bearish is.
So where are we now?
So, putting me in the spot, Hassan. So, listen. Real estate is a long-term investment. I don't know what's going to happen in the next 6 to 12 months, but if you have a 3 years and more longer horizon, I think this is a great time to get into the real estate market, right? Particularly in Dubai, right? Because if you compare it to the rest of the world, Dubai real estate market has been left behind, whereas everywhere else prices have gone up. And what's happening in this place in terms of all the reforms, how well the COVID situation has been handled in this part of the world, I see a massive influx of demand. New population increasing in UAE, and over time you will see that translating into pricing, and we're already starting to witness some of that already. Supply peaked many years ago in 2017, and since then it's been coming down. There's lots of old supply that will come offline, and demand can rise much faster than supply can come online, as we witnessed post 2008 financial crisis. On the recovery, the demand risen much faster than supply could, and that's why you had that big price increase that you saw in 2014. Before that correction, that cycle started downwards as well too. But that's my personal view. Obviously, we're trying to equip you with the right tools so you can make that assessment yourself, and that doesn't mean you blindly go out and put money across the city, because there's still certain challenges in certain areas, and you want to see where the opportunities are for the future. Right, and just to conclude on that, if you look at data, you had seen signs of recovery in the end of 2019, early 2020, just before COVID. We got hit by the COVID impact. So the prices were already, the market was already on a recovery trajectory leading up to Expo 2020, and so COVID derailed that recovery. And then since the reopening August onwards, we've seen record numbers of transactions, sales going back to 2014, 2015 numbers. So there's a lot of activity, a lot of demand, and there's a lot of positive sentiment in locally in the market, and I think that's what's driving the market. That's my personal opinion on that front. Thank you for putting me on the spot there, Hassan. I was trying to avoid the question, and you just kept coming back. See what I have to deal with every day with these guys. They just don't let up. All right, so moving on. The other thing you want to focus on is other intangibles, other qualitative factors, right? How old is the building? Who is the developer? Who's managing the building? In terms of, is my service charges are well taken care of? What are the facilities in the building? What are the amenities around, in and around the area? How easy is the transportation accessible, etc.? All those things come into play. Again, you want to have the criteria set, right? It'll be very, and you have to be fair in terms of how you're looking at it, because if you're looking at a property in Marina, you're obviously going to evaluate, is it a waterfront? Do I have access to the beach or to the Marina Promenade? You cannot apply the same criteria for a building in JVC in the desert, right? So you need to be able to have different criteria for different places, so you're evaluating the right opportunity the right way. Before I move on to the rest of the stuff, I want to pause over here and Hassan, see if there's any questions, because I went through a lot of things in these 5 buckets over here. So if there's anything relevant to these, I can address them before I move on.
Yeah, no, absolutely. I think, one of the factors was, number one, we've been hearing, the market has been bottoming out, or things have been looking better for the last few years. But I think you kind of touched it upon the head that, the pandemic was one event which was an anomaly. People didn't see it coming, as you rightly said, in 2019. In Q4, the market was starting to pick back up. But then, of course, with the pandemic, that things stalled for a bit. I think one of the things that I was answering in the question box was, even when we look at a longer term period, for example, the last 10 years, the market is still up from where it was in 2011, right? That's the fact. People, I think a lot of the times are quite, in terms of their timelines for investments, have a very short term kind of a timeline in mind. So yes, if you're absolutely looking at 2014 up until now, yes, prices have depressed. That's absolutely a reality. But for those people that have stayed invested for a longer time, they have still come out on top. The other question is, though, however, is you mentioned, of course, no one can predict that the prices are coming or when prices are going to pick back up for sure. But people seem to be asking, there's quite a bit of supply that is still expected to come on. And how would that affect the market, number one? And number two, are we still bullish or I guess optimistic about what Expo might have in store for Dubai?
So 2 good questions, right? So before I do that, I just want to circle back on one thing that you made a very good point. If you look at over the last 10 years cycle, right? Because we've gone through 2 cycles, right? 2011 bottom to 2014, and then 2014 to now. And you also have to factor in the currency factor as well too, right? So people, and because if you look at Dubai, majority of the investors in Dubai are non-UAE residents. That is starting to change, which is also a positive sign. I'll talk about that a little bit later. So a lot of them have made a lot of money in dollar terms, because dollar has appreciated and dirham is pegged to the dollar. So even though in 2014 to now, prices have gone down, but dollar has appreciated. So for 1 Indian rupee buying a certain amount of Dubai real estate, and that Dubai real estate price going down, but the rupee going down even more, converting back to rupee, you actually haven't lost money. And if you factor in the income coming in, a lot of these people have actually, made money or broken even and have not suffered the downturn that we have experienced over here, that we see it in absolute terms. That's why it's very important to ignore the noise and focus on the data, because media likes to sell headlines, right? So it's very important that you sort of not get caught up in emotions and look at the facts to understand that. The second point about supply in Expo, again, Expo is a very short-term thing that's going to happen this year, right? And there's lots of supply, yes, but what kind of supply is there? Where is the supply? And is the supply matched with demand or with no demand? That's the right question you want to be asking, right? Of course, there's going to be supply. It's a sign of growth. The country is growing. Of course, there's going to be supply, right? But you want to ask your question, is UAE positioned to increase its population, right? And if you were to ask me, my question to that would be a very hard yes, right? Just what I think the last 12 months has been the biggest advertisement for UAE in terms of how well COVID has been handled. We were one of the first countries to start opening up for tourism and travel. We're relatively back to normal life. Malls are busy, restaurants are busy, there's traffic on the roads, great healthcare, quality of life is great. And relatively speaking to other metropolitan cities, Dubai is dirt cheap compared to other bigger cities that offer the same quality of life, etc. So from that perspective, it's only going to attract more people over here because relatively speaking, cost of living, quality of life is great. There's a lot of reforms with investor visa, with virtual visa, working remotely, which is I think is a big trend for the future, and talks about giving us citizenship, etc. So you're seeing a big push from the government to bring more people. And that's also very positive because your demographic is shifting. Because in the past, the majority of your population was labor, not adding much economic value, but that is changing. You're attracting more skilled people to the economy that's going to have a bigger impact on the economy. They're going to need places to live in, etc. So demand will increase. Is that going to happen overnight? Absolutely not. Is that going to happen by Expo? Probably not, right? But Expo will be a great stage to, again, show to people how great this place is compared to other places, and people will move over here. Population is growing. The city is being built for many more millions of people, not the 3 million people that currently live in it. So supply will get absorbed over time. And in fact, the equation can quickly turn from having too much supply versus the demand to having not a lot of demand, not having enough supply. And you can imagine what could happen into the prices in that scenario, which has been witnessed in the past cycles and other mature markets where they have housing shortages, as to what that does to the pricing of the real estate market. So I don't know if that answers.
No, I think we have a few other questions, but some of them are really good questions. In fact, all of them are very good, but I'm conscious of time, and I think everyone here who attended this seminar wants to know exactly how we can start now evaluating it. What are the tangible skills we can walk away with? How do we analyze it? What tools do we look at? So how about we kind of speed through that portion and show people how that's done?
Sure. I will do that. So once you have this, and this toolbox is not a set in stone, right? You play around with this over time. And once you get through this level, then there's other things that I would add over here that I have not put on the slide, is then you start digging deep in, right? If you're buying an existing property that's already rented, you want to get a little bit more information about the tenant, how long the tenant has been there, who's the tenant, what industry does he work in, nationality, et cetera, and so forth, because then that becomes part of your evaluation criteria. And then there's a lot of other factors that go into it that we can talk about a little bit later as we dive into the specifics. So I'm going to stop sharing my screen so I can share another screen.
Just one thing, just a quick one. Sorry. May I remind everyone to please ensure that their microphone is muted. I know some people can join and unfortunately their microphones are unmuted. So if your microphone or is unmuted, so please do mute it. Thank you.
All right. So I'm going to try my best to keep this process as organized as possible, because there's lots of different things that are available to people to look at. There's lots of information readily available to help you in your process. So obviously, you have access to the property listing portals, and they have lots of data available as well too. We'll talk about those ones. So I have Hausa over here, for example, Property Finder, Youth. But one of the places you can start off with is the land department's website. They have lots of information over here. They have open data research. The website has gotten much better than the last time I was on this website. I don't use it as much, but it is readily available because we use the data from land department with other service providers that have they can visualize a little bit better, and I'll show you those elements as well too. But there's lots of information available here. They have a monthly index that you can download, which is this, the Mosher official sales price index of the Emirates. And it gives you a lot of insights in here in terms of the volume of transactions, what's happening to the price, what's the breakup between secondary transactions and primary transaction. Secondary transactions are people selling in the open market. Primary transactions are people, developers selling off plan or directly from the developers, for example. What's happening month-on-month basis, on a quarter-on-quarter basis to the price, etc. And what's very important is you want to look at the rate of change. You don't want to look at absolute numbers, right? So what I mean by rate of change is at what rate of change from month on month or quarter on quarter is changing. Is that increasing or decreasing? And the rate of decline is increasing or decreasing, etc. That will give you a lot more insight than just looking at absolute numbers, right? Because absolute numbers, they don't mean anything, right? So for example, if you look at this one, overall monthly, 6-month change was -3%, 3-month change was -2%, month-on-month change was only -0.56%. So if you do a rate of change between these three, from 3 to 2%, right, from 2 to 5% in rate of change terms, that is extremely big jumps, and big jumps from a positive perspective, because the rate of decline has pretty much gone to a standstill. Right, we're going close to a zero. So if you go further back out, if you look at 12-month, that number will probably be higher than 3%, right? But now you're seeing that the decline has slowed down considerably at a rapid pace, right? So you got to look at this stuff, right? Because just looking at 0.56% won't mean anything to you, but when you compare it this way, it's very important. So these are small things that I'm just pointing out as I'm looking at this information. To help you with your evaluation, right? So for example, they break it down further in apartments and villas. And if you look at apartments, right, in some places, you're actually seeing an uptick in prices. But be careful on a month-to-month data and so forth. You want to see some trends, because you could have 1 or 2 bad transactions that can distort the data. So you want to see a trend. Don't make decisions just on one data point. You got to look at collective of things. Don't rely on one thing. So have an open mind, look at various things, educate yourself, try to understand why certain things are happening, etc. But don't try the narrative to dictate what is happening. Look at the data and then try to see whether that links with the narrative in the market. So this gives you an overall picture of what's happening in the space. And then you can then when you go specific to a property, etc., that you're looking at, then you can rely some of the information that is available on these listing portals, right? So let's use Hassan. Does anyone can someone shout out or type out a particular area or property they want to look at, for example? We'll use it as a real example to see what we can find out about it, or so how I would go about looking at those things. Hopefully,
right. So we've got Motor City, we've got Town Square, we've got IMPZ. Motor City is another one. I think I'll give it another, 5 seconds. Business Bay, Dubai South, Dubai Hills. So far, Motor City seems to be winning because it's got 2. JVC, Silicon City. I guess, yeah. Dubai South again. So I guess it's between Dubai South and Motor City. Motor City. There you go. 3 for Motor City.
I don't like Motor City. Okay, right. I have a bias against Motor City. I'll talk about why I have a bias against Motor City. But let's dive into this Motor City, right? So depending if you're looking at a studio or a 1-bedroom in there, etc. Let's look at studios, right? So yeah. The information that is readily available on the I don't rely much on listings, because the problem with listings is, a lot of them are fake listings. Agents tend to just put up certain listings to get leads, etc. Some might be legitimate. I usually try to focus on more on the verified ones. That could be also not 100%, but those are better than having no verification on the site.
On that front, just Sadiq, just to spend another 5 or 10 seconds on that. I think a lot of people, when they do go on these sites and they look at these prices, they assume that that is the value of that property. So, you know, I think it's really important to let people know that, yes, these are just asking prices, which doesn't necessarily reflect the value of that property, number one. And number two, as you said, because Dubai particularly is a very broker-driven marketplace, they can effectively put anything they really want up there, and it's not, you know, indicative of the property value.
Correct. So typically speaking, so it varies, right? So if you look at something like a studio will typically have a lower margin of negotiation, meaning very little room from listing price to transacted price. Not to say that listing price will be the transacted price. Listing price is always higher, anywhere from 5 to 20%, depending on the area and the type of unit. But the smaller the unit in terms of the value, the lower the room for negotiation. The more expensive the unit, the more room for negotiation. That is sort of a principle that I follow, right? And it makes logical sense because smaller property, you have very little room to maneuver. For a bigger property, you have a lot more room for maneuvering in there. But what's important over here is I like to use this stuff for trends because you get an idea of what's happening in terms of listing market as well too. Are listings going up, listings going down? Because that also tells you expectations of the seller, who you're dealing with, etc., what's happening in the space. And the other thing I like to see over here is what's the average size of the unit, right? I don't necessarily care much about the pricing and so forth. I want to get at the size because size makes a big difference, right? Especially when you're looking at an investment property, because everything is linked to the size. The bigger the unit, the more service charges you'll be paying for it. So if you're buying an above average apartment in a particular area, you surely can expect the average rent. But if your apartment is bigger than the average, your service charges will be higher because your apartment is bigger. Hence, your return will be lower than the average because you're getting the average rent, but you have an above average size apartment, for example, right? So these are the small little quirks that are available there that you can take a look at to give you a sense of what's happening. You know, every different platform has different ways of showing information. You know, Property Finder has their own data finder. I'm not sure how much of that information is publicly available. So you can see Motor City quarter change. Where was Motor City? It ran away. So we'll come back. Motor City. This is a ticker. What's happening on a quarter by quarter? So there was a negative 5% change. Average sales price, average rental price, and you have to obviously drill this down because Motor City has, you know, a plethora of properties, studios, 1 bed, 2 bed, 3 beds, etc. So you want to look at area. You want to look at things that you can specify, do apples to apples comparison between studios, 1 beds, etc., and not use aggregate information to determine what is happening. So if you look at, we're looking at studios, right? So Hausa also has a price trend indicator as well too, to get a sense of what's happening in the price. And the one thing I like about these guys is they focus on price per square foot, right? Because this will give you a better indication of what's happening at a price per square level than an absolute number, because then you're looking at, regardless of what your size is, you're looking at the price per the size, and you can see this property is already asking well below what the trend has been of the recent past, for example, right? And similar properties and so forth. Bayut has a different way of showing things, but all of them, the idea is you look at these different portals to educate yourself, to get a sense, to start making some sort of a formation in terms of, okay, what's the average asking price And then, what things that might not be easily or readily available to you guys is the transactional data, because that information is typically behind a paid wall or some sort of subscription in it. But you can try to find Property Monitor. They're one of the data providers in the market. Data Finder is another one, and Redin is another one. Redin is the one that we use, and I'll sort of walk you through some of the stuff that we look in Redin that allows us to sort of formulate our opinion on things, right? But you can.
So when you say Sadiq, that people need, if they want to learn about or find out about the transaction history, then that's based on the actuals, right? That's based on precisely what those properties were sold at, which prices, and typically It's that kind of information that's accurate is behind a firewall, as you mentioned. And so these services typically require people to pay a subscription, right?
Yes, and if you have time, you can try to look for it in the land department website. But the problem with the land department website is it's very difficult to find. It's not very structured, and it requires a lot of effort and time to do that. If you are a regular avid investor doing significant amount of, or even if you're looking to make one investment, right, a sizable one, it's worth getting a subscription for a short period of time to give you access to this information, so you can make a decision. And then if you don't want to continue with the subscription, you can cancel it, or you can use it to maintain and to get a sense of your thing, right? But most of these subscriptions are focused on businesses and so forth. They do have retail products. You can ask them, you can contact them, and at least get a demo access, etc., with limited feature, but at least we'll give you something, right? But there's enough information to give you some level of comfort level in terms of what you're looking at least at a 5,000 foot level, to start looking at some opportunities. So this is what we're seeing commonly right now, right? Like you're seeing this index as to what's happened over the last few months, right? And you can see there's a bottoming element, and there's been sort of a rapid rise because of all the activity that's happening in the market, and that's been seen consistently in various data. And then everyone interprets data in different ways, right? So you need to understand different people's biases as well. So, again, don't rely on one piece of information. Do your homework, look at different elements, and make your determination based on that.
I think one thing that's important to note there as well, Sadiq, is just as you mentioned earlier on, and just to reiterate, is, when you look at these trends, it's very easy to look at the macro market trend and then assume that's what your property or the prices you're looking at ought to be doing as well. I think a lot of the times people don't go into the specifics, as you mentioned. If you're looking at a studio or an apartment or a villa, these are different types of asset classes, and typically they'll have different types of trends. So if people do want to make those comparisons, it's extremely important, if you're analyzing an apartment, that you do so with the apartment market, and versus, you can always, look at the overall market, but then I think it just to make a more informed decision, as opposed to going on general data and then assuming that's what the property you're looking at ought to be doing as well.
Agreed. Absolutely agreed. Yeah, it's always apples to apples comparison, etc. So, for example, Property Monitor has a lot of this information. You don't get to see a lot of trends. You got to do it month by month. It's only for the last 3 months. You get a snapshot, but if you have the time and effort, you can put this stuff in Excel for different months and sort of build your own trend analysis over time to get a sense to what's happening, etc. Because this is just giving you a price per square foot, which is great because you get a sense of what's the average transaction. And this is transactional data. This is not listing price. This is actually what's or what the units are transacting on average in that particular area across different sizes, etc. And generally speaking, the smaller the unit, the higher the price per square foot. The bigger the unit, the smaller the price per square foot, right? And then also trying to get a sense of what's happening on the rental front, and then the change, a month-on-month change. So, you can actually see in terms of villas, where is the activity, where are the prices. So you can see prices actually going up, right? In certain areas, in most areas of villas, in certain areas, not so much, right? Or less, but again, this is January to February. You want to compare that to what happened from December to January, and then November to January, because you want to see a trend. You don't want to see, there could be just 10 transactions this month that shows this, right? So you want to see a trend of these things, not just rely on one particular month. Same thing with the apartment. You're seeing a lot of increase in certain areas, not so much in other parts of the world, and you want to try to understand as to what's happening, right? So, and then this will give you a sense of supply, demand, etc. Right? So, you guys, some of us talking about Dubai South, for example. Dubai South is still in a position where it is not performing as well as some of the other places, and that could be various factors, right? Because there's lots of supply expected over there. The airport has been delayed. A lot of people are working remotely. They don't need to travel to Jebel Ali to work unless you have a physical job. But if it's an office job, etc., you don't necessarily need to travel. So people are willing to stay where they are. They don't need to move closer to work, etc. That could be it. But would that trend continue? You want to be asking. Maybe if you have a view in 2027, that airport will eventually open, and the city is moving in that direction with the expo site, etc. If you have a very long-term horizon, it could be a really good time to buy these properties that are still playing, are lagging the overall market. As the market is getting ahead, these properties are taking time to pick up. It will eventually get to a point. So it depends on what you're going back to your why you're investing, what's your time horizon, to make those kinds of assumptions and assessments to decide what you want to do. Because generally speaking, when you look at Dubai overall, historically speaking, when things start picking up, it's usually affordable areas and really prime areas that sort of lead, because investors tend to flock to those areas because they're tried and tested areas, and then other places follow, right? So you need to understand which area is going to lead, which area is going to lag, and you want to take advantage of that situation.
Sadiq, on that note, just, you mentioned that, people may want to assess for themselves what's going to happen, whether, for example, in the case of Dubai South, as you mentioned, maybe people continue working remotely, whether that's going to cause more people, whether that's going to cause demand to increase there or not. I think there's an element of, obviously, when you're analyzing properties, an element of qualitative versus quantitative factors, right? And even when you're analyzing these quantitative factors, these are all historical. So if you want to be forward looking, you have to obviously hypothesize about some of these qualitative factors that you might want to take into consideration. So I guess my question is, for everyone who has tuned in today, what are the absolute, I guess, quantitative, black and white things you ought to be looking? Because I think people can have opinions, right? Oh, I believe Dubai is going to pick up. Oh, no, I don't really think Dubai is going to pick up. People have opinions about that. But if I'm looking at, historical data, that is accurate. So how would I use that data in my analysis?
It's a question to me, right?
It is a question to you.
So, all right, fine. I'll focus on the hard data, right? So, like I said, you want to go back and look at a trend. You want to look at what's happening, look at the data instead of just looking at the narratives. Obviously have your views in place, but you need to back them up with actual hard data. So what I'm trying to show is where you can find those data. And then once we go into the model, we can try to talk about how you sort of translate this data to evaluate it. But the things that I look at is I want to get a sense of what's happening in the market, what's happening, what's the average asking price, what is the average transacted price. So I get a sense of where this property will line up. There's another tool that is available here on Hausa where they provide property valuation. You can put in the area that you're interested in. Again, these people are in the business of selling properties. So, all these things are behind a paid wall or some sort. I don't want to give my name or email address to these guys, so I'm not going to put in anything. But actually, let's just let's see if it works. As long as I don't ask you for verification, it could work. Okay. So let me see if they send something. No, nothing. But they tend to provide some sort of indication valuation report. It won't be a formal valuation report, but they have access to these paid subscription where they're able to give you a better insights of the property. But you want to be careful because obviously it's a biased information into that will come from an agent, then you're trying to do it yourself. But at least it gives you a sense in terms of what people are saying about a particular area and so forth. Once you have an understanding of what's happening at a property price level, you want to look at the rental side of things in terms of, because obviously you're looking as an investment, you want to make sure you're getting an appropriate yield for a particular area. So you want to look at, what are the, so, assume we get a sense that, studios are somewhere around low 400, high 300s to low 400s, between 370 to 410. I can find a studio, right? But then you start looking at the rent. There's 361 listings. Mind you, not all of them might be real. Some of them might be a lot of fake listings, etc. What this means is like, well, I'm going to compete with a lot of people to rent my unit, right? So I'm going to struggle to demand top dollars. So I got to look at, what's the average rent price for this unit. You start getting a formulation in terms of what the rental prices are and what they're trending at. And rentals are obviously been under pressure for a long time because of this excess supply and people having lots of options, and landlords being very flexible in terms of providing payment solutions and so forth. But there's different strategies that you can adopt, right? So these are your typical studios, unfurnished, etc. But then have a look at, what if I look at furnished units? Does the price change? Yeah, furnished units are starting at 31,000, supposed to 26,000, another extra 5,000. How much does it cost me to furnish the apartment? Maybe 5,000, maybe 10,000 dirhams, but I'm generating much better return, and I'll have my furniture paid off in a matter of a year or two because I'm getting a higher rent. What if I break it down, instead of paying yearly, if I pay monthly? Does that make a difference? Right? Yes, I can rent something out on a monthly basis, close to 4,000 or 5,000 dirhams. That's like 50, 60,000 dirhams, as opposed to only renting it out for 28,000. But that doesn't necessarily work in every single area, etc. Right? Because in Motor City, there's only 3 furnished on a monthly basis. So there's not a lot of demand for people to live in that sort of lifestyle in Motor City, but that might very well be true for some other areas. What this does, it allows to get a sense of what is my return potential of that property in that particular area. Once you have this, then you got to do further deep dive in, right? You got to look at what your expenses are. Your biggest expense for a property is service charges, right? And the way land department has access to this, because a lot of owners are very lazy. They don't keep track of their service charges invoice. So when you ask brokers, they will have no clue what the service charges are. So you should always ask for a legitimate receipt. There's a muallaq receipt, which is because all the service charges are flown and approved through the land department now, and they issue an invoice. So you want to request that, because that gives you the authenticated costs per square foot for your service charges, to get a true sense of what the cost of service charges is. Don't rely on someone telling you what the service charge is. Ask for factual information, and you can always go to the land department website, or you can just Google DLD service charge index, and it will bring you to this page, and you can easily see Motor City. Pick up the building that you're interested in, and problem with this one is some of these are very dated, very old index. This one is a good one because it's 2020, and here it will tell you what the service charges for the year are, right? So 15 dirhams per square foot. So if you're buying a studio that is an average size 400 square foot, 400 times 15 will give you your square footage, your service charges for the year. Then what you want to do, because this is your fixed cost, you got to pay service charges whether the unit is rented or not rented. And then when you get your service charges, you want to look at what percentage of my rent I'm paying in service charges, right? Because that money is not coming into your pocket. That money is going out to someone else, right? So the higher the percentage, that ratio, the more money you're paying in service charges. You typically want to, when you're comparing a couple of opportunities, you want to have an opportunity that has a lower service charge ratio to rent, meaning there'll be more money left over to go into your pocket than to going towards your expenses. The other thing you want to understand from expenses is, property insurance. I would recommend you should have property insurance. God forbid something happens beyond what's covered in the owners association and so forth. You want to have some level of extra security, and doesn't cost you a lot. It's extra 300, 400, 500 dirhams a year, not a month, a year. So it's worth doing that. And if you are not managing it yourself, you're managing it through a third party, you want to factor in property management. Typically anywhere between 3 to 8%, depending which property manager you're using. And then your other incidental charges, if there's any maintenance issue you want to change, toilet, etc., and so forth, any sort of regular upkeep. Some are responsibility for the tenant, some is responsibility for the landlord. So you can factor in 1 to 5% as a benchmark to get a sense as to what my return might look like, and then start stress testing your rent, your service charges to get a sense of how my cash flow, my return would look like. The other thing you want to factor in from a serviceability perspective, right? If you look at the toolbox that we go back, so we just looked at the cash flow, serviceability. How easy would it be to rent an apartment in Motor City? As you saw, there's lots of listings that are available, right? There were 300 something listed on Property Finder. Bayouth had how many listed over here? There seems to be a lot of studios in Uptown City as well too, listed over here as well too. So that means it's going to be difficult, challenging for you to rent out. But it's important to understand why that might be the case, right? Because you might be able to adopt different strategies, make it more flexible, etc., to get more rent. But one of the challenges, and this is because we do all this homework with Motor City, is district cooling, right? It's cool in Motor City, and Motor City tends to have a notorious bad rep around cooling charges that can be extremely high. And there's lots of particular areas that have this nuances. Motor City is one, Discovery Gardens another one. There's a few other places where there's cooling charges, and what cooling charges does, whether the landlord is paying or the tenant is paying, it's a cost. And if it's the tenant that is paying, it's an added cost that tenant does not want to pay, right? So that makes the apartment less serviceable from renting perspective and so forth, sort of giving you a sense as to how you score that opportunity in that particular bucket. From a community perspective, it's a phenomenal community. There's lots of amenities. If you've been to the Motor City, that commercial area, it's phenomenal. It's like you're not in Dubai, you're in some Western city neighborhood, because they got lots of things that are happening over there. It's a very lively place, right? And from a location perspective, it's not so bad. You're right around Sakim, you have access to 311, Al Khail relatively easily. You can drive up and get access to Sheikh Zayed. So all those things score really well, but when it comes to actual quantitative stuff, it sort of fails. So then you start looking at it from that perspective and start scoring it, and then you compare that to what other opportunities that you have available in that price point to make that decision, right? We obviously have access to a lot more data. So to give you a little bit more sense in terms of the kind of stuff that we look at, we can get access a lot. So I'll give you an example of the kind of things that I look at. I'm cognizant of time, Hassan, so if there's questions, feel free to. I'm going to quickly try to run through this to give a little bit more sense of kind of data that can be
I think what would be useful is definitely, I think, jumping ahead to the models that we do have. And I know this is all very interesting, and people, I think, are getting a lot of value here. I think one question we just got right now is, how do we know which area has cooling charges, or rather, I guess, which building or which property how do you determine that?
So Google is your best friend. You'll be surprised how much I use Google in terms of my evaluation, right? So Give me 1 second. Let me just pick a building name. I'm really bad with names. Let me find where was we here? Motor City, Bennett House. Bennett House. This is, sorry, bad example. Cool. So again, a bad example, but one of the things I look at, I'll look at Google reviews, right? Because a lot of people will write about their experiences living in the particular building and so forth. Obviously, you don't want to rely on one review. You want to look at buildings that have, lots of reviews, and you don't want to look at old reviews. You want to look at recent reviews in terms of how things are happening. You'll get a lot of insight from that perspective. And then obviously when you're looking at opportunities, whoever brought the opportunity, you should have a response or an understanding. Just ask the question, right? Just ask if it's a diva or not. Generally speaking, low rises don't tend to have district cooling in places like JVC. High rises will have cooling. Downtown, Business Bay all have cooling, but MR tends to include it into service charges. And some buildings, some developers do that. Cooling is included in your service charges. So it's a responsibility of the landlord. It's not a pass-through to the tenant. Sports City is all cooling, district cooling. Motor City is all district cooling. IMPZ is district cooling. So it varies. It varies from different. And just ask the question. That will give you. It's just simple to ask instead of trying to figure out on your own. Doing research on the website. I'm going to quickly jump into this Excel model, walk you through it, because this is going to be shared later on. So I just want to walk you through it so at least you have some sense of what it is and how it works. Hassan, you can see the screen?
Yes, we can.
All right, cool, awesome. So before we dive into the model, I just want to sort of quickly run through a couple of return characteristics, criteria that I look at. So when you're looking at the numbers, it makes sense to you. So gross yield is effectively the rent that you're getting on the property divided by the property purchase price, right? It's a very high level number. This does not include any expenses, etc. So you're just getting trying to sense of your starting point as to what is the income, cash that is coming in before analyzing what cash goes out and what's left over. Net yield is what is money coming in minus all the expenses divided by the property purchase price. That gives you your net return, net yield. But this does not include your mortgage payments, etc. Annual return on investment is something that is cash in, all expenses, mortgage payments out, etc. Divide by the cash that you put in as a down payment to get that mortgage, the return on that money, that's your return on investment. If you did not borrow, and buy the property through mortgage, you bought it on cash, in that situation, net yield and annual return on investment will be the same. But obviously, if you leverage, you borrow money, you're putting less of your own money, you're taking banks' money, obviously you're paying them back something in terms of principal and interest charges, etc. But your return typically in that situation will be slightly higher than if you did a complete cash purchase, depending on various characteristics of different criteria and so forth. And total return on investment is your total return over the holding period. So if you held the property for 5 years, 10 years, it's all the income that you have generated during that period, plus any capital gains, meaning you sold the property at a higher price, or capital losses if you sold it at a property lower than what you had bought it for. All that income that you have generated, that gives you the total return on your investment over the entire holding period. And internal rate of return is just trying to understand over time that the return that you have made, present valuing it today, what is the average return that you have made on an annual basis, right? IRR is typically something I'm not a big fan of when it comes to real estate investing, with lots of other components that you got to look at. And IRR doesn't necessarily give you a true value of it. I'll demonstrate that once we look at the actual numbers. But have it, look at it, but don't rely completely on IRR when it comes to these kind of things. There's also other things that you want to look at when you're evaluating real estate investments. So don't get overwhelmed by this. The idea over here is to give you a tool that is robust enough and flexible enough for you to play around with, to get a sense of how to evaluate opportunities. So you don't have to do any number crunching. You just have to put numbers in and try to understand what the numbers mean and what the results are coming out. So this is just a starting period. You can put any date you want to put in as a starting period for the time period. These first two lines are just inflation. What do you think the rent is going to increase on a year-by-year basis, or service charges? If you don't have a view, you can keep it zero throughout and look at assuming no increase in rent, no increase in service charges, or you can make assumption that not every month, not every year, but every 2 years it increases by 1% or whatever that may be. So you can play around with that as you see fit. Right? We're going to focus a lot in terms of the inputs over here. So everything that's highlighted in yellow is an input. Everything else is an output. Do not touch this. You won't be able to do it. I think it will be locked when you get it. It's not locked right now, but it will be locked, right? So only play around with the variable, the yellow boxes that are inputs. So you want to start, like I said, you want to focus on what the price per square foot for a property is. What's the square foot of that property, and that will dictate what the purchase price is. And then if you are making using debt to invest in that property, you obviously have to make some assumptions. What percentage of down payment you're paying? How long is your mortgage? What's your mortgage rate? Typically, banks require to do a valuation fee. What that fee is? What are the bank charging you to initiate this mortgage? And what is the early settlement cost, right? Because if you break your mortgage before the term is over, some banks typically charge you a penalty, etc., and what that is. And that could be various things. You can play around with it. You can change it, whether it's not 1%, it's 0.5%, or it's 2%, whatever that is. You can play around with it, and the numbers will change. This cash requirement is, if you were buying this $500,000 property with a 25% down payment, you effectively will need $143,235, because this encompasses all different things that you will need, including paying the land department fee, the brokerage fee, the valuation fees, the bank fees. A lot of these things can be financed. So all lump sum together, it works out to 29% of that 500,000 is the cash that you will need, right? If you're buying it on cash, you need 500,000 plus the DLD fees, etc., and so forth. And that's already factored into the model, so you don't have to worry about that, because those are standard costs. Then you want to look at what are the rental assumptions, right? Is the property currently rented at? Great. If it's currently rented at, what is the market rent, right? And that's a very important distinction, because you might be buying a property today that is rented very compared to the current market at a very high rate, and it might be up for renewal in the next few months. And indication could be that it might rent at a lower rate. So, or there may be other reasons as to why you can maintain that rent. Maybe it's rented on a monthly basis, etc., furnished, and that's why it's demanding a higher rent. But understand that, and then here you have the option to pick whether you want to use the current rent or you want to use the market rent to evaluate, and that will give you results based on that element, right? So if you want to use market rent, you just from the drop down use market rent. If you want to use the current rent for evaluation, you can do that as well too. So that flexibility is built in there. You want to know what the service charge per square foot is, how much you'll be paying the property management to manage your insurance, annual maintenance costs, and occupancy. Occupancy is important because you're assuming I'm going to be 100% occupied, or you can assume 95% occupancy, a week, 2 weeks, 3 weeks of turnover between tenancy, etc., and so forth. So you can play around with this variable and see what happens to your cash flows based on that. And then you make an assumption of what do you think the annual appreciation for the property will be, and how long you want to hold on to that property. Once you put all this, it's going to spit out some answers. And over here, you have a dashboard that compares, if you were to buy this on cash, what the returns would look like, and if you bought it on a mortgage, what the returns would look like. So if you bought this on cash, you would need 536,360 dirhams because DLD fees, trustee fees, etc., and so forth. Based on these rental assumption and these cost assumption, your current gross yield is 7.6%. Your current net yield minus all your expenses that you're paying is 5.52%. And over the 5-year holding period, your average gross yield is 7.75, and your average net yield is 5.64. The stuff that you want to focus on is what's your average annual cash flow? How much cash is actually coming into your pocket? So based on market rent of 38,000, you can expect to generate 28,178 dirhams in your pocket every year on an average over the 5 years of holding period, based on these inflation assumptions and so forth. This is the money that's going to be coming into your pocket. And service charge to rent ratio is one of the key components that I talked about. This is important to look at. Typically, the market average right now in Dubai is anywhere between 20 to 25%. So anything that's below that, to me, is a very attractive opportunity, because that means service charges are low, my yield is protected. Even if the rents come down a little bit, my yield will be protected because I'm not paying so much in service charges. So that's a key component that we look at, right? And then based on your assumptions of appreciation, in 5 years, assuming the price grows 2% every year, this will be your exit price. Your capital gains won't be a lot because you've held the property for 5 years only. But if you held the property for 10 years and it grew 2% every year, then obviously the price will be much higher. Your capital gains will be much higher. But when you buy a property in cash, your biggest chunk of your return is coming from your income, because you're generating cash, right? So your total income is 140,000. Your capital gains is 15,000. So you've made a total return of 155,000 off your cash investment of 536, which equates to a total return of 29% over that 5-year holding period, for example, based on these assumptions. Now, if you compare it to a mortgage one, you will see that your current gross yield is identical, because that's just the gross yield. Your cash requirement is obviously lower because you're borrowing money from the bank. But because you're borrowing money from the bank, you're paying bank monthly payments for your mortgage payment, and you can see your annual yield, your return on investment is next to nothing, because all the money that's coming in is going to the bank to pay for the interest and the principal, right? Yes, the principal that you're paying to the bank is being built up over time as your savings, but in terms of cash coming into your pocket today is very little. As you can witness over here, the average cash flow over that 5 period is only 1,300 dirhams. So you invested 143,000 and you're only generating 1,300 dirhams in your pocket every year, less than 1%. You might as well keep that money in the bank, and you probably can get a little bit more, and it's more liquid. And as you can see, the majority of your gains are coming from capital gains, right? Because when you will realize money or profits when you sell the property in the future at a higher price. And that's why your return is higher, because you put in less money and you made a lot of money, but it's all linked to capital gains. If you don't have any capital gains, for example, you don't get that much of a return. And the delta between a return on a mortgage and the cash shrinks considerably, but you take in massive risk by borrowing money as opposed to being fully cash, right? And the other thing you want to factor in is what happens if my interest rate changes. If it goes even higher, I can potentially be losing money and I have to pay out of my pocket, right? And this, if my mortgage rate goes from 3% to 4%, I'm actually giving money from my pocket to maintain this, and I'm actually all my returns are going to come from capital gains. And if the capital gains disappear completely, I'm not making much money. The only money I'm making is the principal that I have paid over the 5 years. And typically in real estate, the longer you hold the investment, the more money you make. So the longer your holding period is, the more cash you're generating, the more returns you will make over time. So this gives you all that flexibility to play along with. And then what we have done over here is give you the ability to play with sensitivities. So there's key areas over here, such as mortgage rate is a big variable. The rent is obviously a big variable. The service charge is a big variable. The occupancy of the property, and what's the annual capital appreciation. And you can play around with it. If my rent were to increase by 5%, what will happen to my returns? If my service charges were to decrease by 5%, what will happen to my return? If my occupancy went down, what will happen? If my mortgage interest rate went up, or my appreciation went up or went down, what will happen to my returns? Etc. You have that functionality to play around with it to get the results, and you can always reset back to zeros to see what the returns are, and these are all variables. So this is a tool. The best thing to do is build it yourself. because then that will give you a lot more education, a lot more insights as to what you're doing it. But you can spend some time on this, trying to understand how this is done. All the workings are over here, a little messy, but if you have the time to follow the formulas, you can do so. Or you can, this is a good starting point for you to play around, plug in your numbers to get a sense. And the idea is to help you sort of get comfortable evaluating yourself. And you can always, use our platform because we provide all this information in a very accessible manner that you can use to sort of educate yourself, test yourself, and work alongside with us. Doesn't mean you have to necessarily invest, but you can use the material that is available on the platform to get you comfortable with how you look at these things.
Sadiq, on that note, I think a lot of people probably have this question on their minds, and we got a question on this as well. Is when you do calculate that net yield, we do know that just the cost of doing business in Dubai, you are typically going to deal with a broker, so you're going to have to pay the 2% broker fees in most cases, and of course there's the 4% DLD fee. So when you're calculating net yield, do we take that into account when calculating? How would you go on about that? When you're calculating your own return, and versus what we do also here at SmartCrowd, I guess.
Yeah. So typically I look at total return on investment as my key criteria, and that one includes everything. So this total return on investment is being calculated on your full loaded costs, meaning DLD fees, etc. On the net yield, not so much, because you're trying to look at what the property price is, because from a comparative perspective, that's what you're looking at. And from a SmartCrowd particularly perspective, those costs are amortized over 5 years. So if someone sells their property in year 1, year 2, etc., we reimburse those costs. So to keep the returns comparative, we don't include that in the return, because if we did, then people will be trying to sell, trying to recoup those costs as well too, where we reimburse those costs regardless. So it doesn't have to be factored into the return calculation. There's a little bit more information on that on our website that talks about it in more detail, but that's the reason as to why we show it that way. But what you want to look at is a total return, and in our pro forma that we provide on the SmartCrowd platform, we do provide total return on investment, and that is on a fully loaded cost over a 5-year holding period, because over 5 years those costs are amortized and that cost belong to you, and you want to look at the return.
So just to pause on that one, right? Because I know there are quite a few people here on this session with us there that are sophisticated, that do understand these terms. But when you do say amortized, what exactly do you mean?
So for example, brokerage fee, right? So when you buy a property, you pay 2% brokerage fee. So for this 500,000 dirham apartment, you're paying 10,000 dirhams in brokerage fee. So you amortize it over 10 years, meaning that's the cost that you're amortizing over 5 years. So 2,000 dirhams a year. So for example,
so it's like from a pro rata basis perspective, you're looking at that as a cost and you're minimizing it, and you're removing that on a yearly basis depending on its total cost, so that it doesn't take a big hit, just in the first year, as an example.
Yeah, exactly, right? From an accounting perspective, but from a SmartCrowd perspective, for example, if you bought this property, right, and you paid that and brokerage fee, and you decided to sell this property tomorrow to someone else on the platform, it's unfair for you to pay that entire 10,000 dirhams, and someone else comes along and buys your asset and benefits from that. So what we do is, you held it for 1 year, we charge you 2,000, and the remaining 4 years, the new buyer who's buying those shares from the investor will pay the remaining 8,000, and we reimburse the original investor 8,000 because he paid for the brokerage cost upfront. But if he held the property for the entire 5 years, then he's availed the benefit of holding that property for 5 years, so that 10,000 that cost is allocated to him. But if he sells in year 1, only 2,000, 8,000 is paid back. If it's 2 years, 4,000 and 6,000 and so forth, in very simple terms, right? But obviously there's other costs that needs to be factored in, and there's some costs that are sunk costs, one-time costs, such as land department fee, right? That's a transactional cost that you have to pay every time you do a transaction. So that's not amortized, that's a one-time cost that is paid, for example.
Right. And you mentioned that, when people are looking at this, and if they want a holistic understanding of how much money they're making, because ultimately when you are investing, you're doing it with the purpose of making money. And you mentioned that in the case of SmartCrowd, we do provide people a pro forma. It's not the same Excel model that Sadiq is sharing right now, which, by the way, we will share with all our attendees. But that pro forma is effectively an Excel model for that specific property where you can run various different scenarios, plug and play numbers, and see exactly what the return on your investment might look like over a course of 2, 3, 4, 5 years, even more years if you want to hold up that asset for a longer period. But one thing that I will mention there, the caveat is you need to be a fully registered user. So if anyone who's listening out there and you are not a fully registered user, you will not have access to that. So we do urge you to complete your profile with all KYC requirements, and then you'll have access to all the data and spreadsheets that Sadiq is talking about.
It costs you nothing to register. It's absolutely free.
That's great. That's fantastic.
So,
all right. So just on this Excel model, I think what's important to let people know is, of course, I mean, Sadiq's really gone to town with this and given us a lot of detail in terms of all the different key figures that you ought to be looking at. One of these sheets, the one that you're looking at right now, is the inputs and dashboards sheet. So it's all really ready, set, and done for you. So effectively, all you need to do is plug and play. You don't even necessarily need to know how those figures are being calculated. Of course, you can go back into the formulas and see exactly which cells are being picked out and, start learning exactly what is being done. If I am looking at these figures, Sadiq, I know all of these are important, but if you were to pick the top 3 metrics that I ought to be looking at in this dashboard, what would those 3 be?
So for me, cash flow. And this is a component of cash flow, the service charge to rent ratio. But I would look at that collectively because one has an impact on the other. And the other area that I would look at is your return profile. This is a very balanced return profile, right? Because 2/3 of your return is coming from income, and cash in hand is much more valuable than cash in the future, because you can take this cash that you're getting every year and invest it into other things and compound. And this is the beauty of real estate investing. When you're creating a cash generating investment, you can use that to generate even more investments, because you obviously have saved up enough money and bought this property and you're making cash. And assuming if you have a job, you can take all that money from the job and spend it and live your life and use this cash to save and invest into other things. You can buy another property, you can buy other investments and have that grow. You can do that every year. So having the cash is very important. So 2/3 of your returns are coming in cash and 1/3 is coming on capital gains. So you're getting a very nice balanced overall return and a very healthy return overall. So that's what I would focus on, because when you compare that on a mortgage basis, you're predominantly relying on capital gains. So imagine if you had bought something in Dubai real estate at 2014 on mortgage with the hopes of getting capital gains. You wouldn't be very happy today. But if you had it bought on cash, yes, the prices have come down, but you still generate income, right? That you could have used to invest in something else that might have gone up. So your overall portfolio would have been nice and well balanced. And that's going back to my point as to why real estate investing is so good, is because it helps you diversify and build a more diversified, balanced portfolio, because that income coming in provides you to invest into different things and generate more wealth. So, I'm not to say, don't finance your investments and so forth. That'll be a misguided recommendation, but you want to be careful as to how and when you're doing it and how much you're putting that. And that's why it's important to stress test, right? Because, a lot of people will tell you you want to be buying, etc. You can mortgage it and buy it and so forth, which is great. But you want to stress test. What happens if my property goes vacant? Do I have enough money to pay the mortgage payment, right? So, for example, if my occupancy drops, right, can I afford 8,000 dirhams a year to pay for mortgage out of my pocket? Right? What happens if the interest rates all of a sudden rise and it becomes 11,000? So you want to be able to do that. So there's different ways to manage this. So you can manage this by, reducing your down payment, right? So increasing your down payment rather. So instead of borrowing 75%, borrow only 50%, and you just mitigated those risks. So this is why it's so important for you to stress test and just not rely on one variable, play around with it. And it's okay to take time to make the decision. Don't be impulsive and use this. And if you need advice, go seek independent, unbiased advice, right? Not to say don't talk to brokers and so forth, but keep in mind, brokers have a commission to make by selling you something, right? So don't ignore them completely, listen to them, but then also get some other unbiased opinion, insights if you don't have the capacity to do it yourself. So those are things that I would focus on when I'm looking at it.
Just a couple more questions, and I think then we'll probably open it up to everyone else who might have some last kind of final questions, and we can get to those. One question we got asked earlier on, which is a very good question, is that, or rather a comment was, the inflation risks are rising, right? So when it comes to calculating your break-even rate in terms of, inflation risk, what should you be doing from an ROI perspective? Is it, at that point, should you be looking at a higher yield, higher rented property that provides you with a higher return to maximize that? How would you go on about that in today's terms?
Yeah, so absolutely, right? So if inflation is rising, that means everything is getting more expensive. And to combat that inflation, interest rates will go up, because if interest rates don't go up, you get this rapid hyperinflation element. The governments, the central banks are forced to raise interest rate to keep that inflation tamed, which increases your cost of borrowing, etc. And then, if interest rates are going up, then people are more inclined to put money into fixed income, and meaning other investments need to provide a better return to compensate for that. But none of these things happen on a linear basis, right? So if interest rates are going up, what happens? It becomes more expensive for people to buy. If less people are buying, you would think the prices might drop. It very well might be true, but guess what happens? Because less people are buying, more people need to rent, rents start going up. If rents start going up, the investment becomes more attractive. So investors that have money start coming buying it, and your rents will go up. So your returns gets, but this doesn't happen in a linear fashion, right? These are like macro theory policies that are not linear, and everything has to stay constant for the other thing to happen. But generally speaking, real estate is a great hedge against inflation, because a hard asset, anything that's hard asset, is a great hedge against inflation. Precious metals, real estate, other commodities as well too. So in an inflationary environment, you want to be holding hard assets, because they will rise in price as well too. And rents will also increase because of inflation. Inflation is just generally cost of living goes up, which includes your rent. So unless the government comes in and puts floors, but that's something totally out of our hands. But generally speaking, with inflation, rents will increase, and if the rents increase, your returns will naturally become higher, because you're generating more return, because your cost of acquisition was what it was today. And if there's inflation in the future and the rents go from 38,000 to 80,000, your ROI on your investment is going to be tremendously high to compensate for that inflation. I hope that makes sense.
No, I think that makes a lot of sense. And if someone has any additional questions on that, we can absolutely get to that later. We can have a chat offline, and we can definitely discuss that. One thing that, before we get to the final questions, is we have an important announcement, right, Sadiq? From my understanding, in the next 2 days, there's something that's coming up that's super exciting. People have asked about this in the question chat. So why don't you let people know what's happening in 2 days' time and how that's different to how we currently do things here at SmartCrowd?
Sure, Hassan. I'll do that. But just to wrap this up a little bit quickly, just to help you gauge things, you want to be looking at no property is alike, right? Looking at a property in international city is very different from looking at a property in a prime area like Palm, right? So you need to understand the characteristics of different things, right? Because that will help you evaluate the properties appropriately, right? So, properties that are more focused on income, like affordable areas and so forth, tend to have higher cash yield and typically lower capital appreciation. You won't have very robust capital appreciation, a lot of volatility, because things move very rapidly over there. Whereas something in the prime area like Palm and so forth will typically have a lower cash yield, but a higher capital appreciation and lower volatility because they're more stable. And these are sort of high-level guiding principles to help you bucket different properties in different areas, so you can understand the different characteristics and relate it back to your why in terms of why you're investing. Are you investing for a steady cash flow? Are you investing something you want to put your money in and sell at a profit in the future? And what helps you sleep at night in terms of volatility and management of that asset? So this is just a sort of a high-level guide to help you with that. And talking and just going back, make sure you have a criteria. If you don't like this criteria, build your own criteria, but have something in place so you have an objective way of evaluating your investment opportunities. So the exciting thing that's happening over here is because, like I said at the start of this webinar, one of our missions is not just to give people accessibility to real estate investing, but also make people smarter investors. And people that use our platform love it. We have a very high reinvestment rate. Almost every investor that we have has multiple investments on our platform. And it's what we find is always difficult to take that first step. So this Thursday, for a limited time only, between the hours of 2 to 4 p.m., we're hosting a Smart Hour, where in those 2 hours, we're dropping our minimum investment on our platform from 5,000 dirhams to only 1,000 dirhams, right? And the idea there is to give everybody an opportunity to experience investing through SmartCrowd, to understand see how easy it is, how convenient it is, but also the kind of information we provide. And once you get the taste of it, we're very confident that you'll continue to use our services going forward. So just this Thursday from 2 to 4 p.m., our minimum investment requirement would drop from 5,000 to 1,000 dirhams, allowing you to get a taste of SmartCrowd platform at a fraction of what our minimum investment is, to give you guys a chance to do so if that 5,000 is holding you back.
That's super exciting. I mean, yeah, I think a lot of people will be super stoked about this. It's just for 2 hours, as Sadiq mentioned, 2 to 4 p.m. This is Gulf Standard Time, so Dubai time. If you're in any other time zone, then please do adjust your clocks accordingly and tune in during that time. We'll also be running a live kind of a Zoom session similar to this, where you can come in and ask questions specifically more about SmartCrowd and how investing on SmartCrowd works. The purpose of this session today was to give you value-added content and to provide you with a glimpse of exactly how it is that we look at how it is that we analyze properties or start to analyze properties here at SmartCrowd. Of course, we do take into consideration various other factors. We have a proprietary system. We look at hundreds of data points, and although this is a really good start for someone who definitely wants to get started in property investing themselves, and then they can use this Excel model. So we are going to be sharing this with all participants. One final thing, I guess, if you do have any questions specifically about SmartCrowd, I did see a few. We can reach out to you individually. I am conscious of time, so we'll make it a point to reach out to you and email you some of these answers, or you can email us at info@smartcrowd.ae with your specific questions, and we'll make it a point to answer them, get on a call, and answer all the questions that you may have. So on that note, I think we'll call it a night. What do you think, Sadiq? And give everyone, we've kept everyone here caged for the last 2 hours, so I think this is a good opportunity to end the night.
Yeah, no, I apologize. I tend to talk. I was just looking at some comments and over here. I want to shout out to Shulton over here, who summarized this in a very nice way, if you allow me, Hassan.
I read it, yes.
Yeah, so if you, maybe Shulton, if he's still around, do you mind reiterating that? If he's still around, I'm just trying to see if he's if he's still there. If you're there, if you can unmute yourself and yeah, you are still there. Sorry to put you on the spot there.
I mean, I think he commented, to be fair to him, I think we can probably just read it out, and we can tell everyone exactly what Shulton said, which was very relevant, and we're super happy that Shulton said, the tool can be used for education and shows that property investing with high leverage is kind of like gambling, and I would assume that that's with the context of the current times as well. It's not worth the risk, he says. That's why SmartCrowd is a wise choice. No leverage, no debt, small investments, and that's the conclusion, I guess. So thank you for that, Shulton. Really appreciate that. Really appreciate the support. We really appreciate you all being here with us. Make sure that you have registered and you have your account up and running if you do want to take advantage of Smart Hour on Thursday. And on that note, we'll say good night. Thank you so much, everyone.
Thank you.
Can we have the recording for this one?
Yes, so the recording will be shared. Recording will be shared. The Excel model will be shared for everyone who is in attendance. And yeah, you can go to town with it then.
Thank you very much. The session was really wonderful and nice. Even I linked with property across multiple countries, but the information you provided was really nice. Even for me as an experienced person, I didn't get all the things. They were very too much technical also. To my expectation, it was a great learning. And I'm looking forward to be as an investor with you guys. I'm really impressed with your knowledge.
Thank you very much for that.
Thank you so much,
Thank
Said
you.
Kamal. Really appreciate it.
Just as people are dropping off, I'm reading through the comments over here. There was a couple of conclusions around leverage and so forth. I just want to make sure I'm not sort of being too biased towards one or the other. Leverage can be used, if it's used appropriately, can be very helpful investment. But one way of looking at it, of comparing whether leverage is good or not, is comparing the cost of borrowing compared to what the net yield is, right? So when you look at a net yield, this is the net yield that's left. We talked about rent minus all the expenses that is left over in your pocket. If the net yield say is 5% and your cost of borrowing is 4%, your margin is only 1%. So there's very little room for you to make any money. So typically leverage works really well if you can borrow at very low and invest into something that's giving you a really high return, so you can make even more return. So for example, borrowing at 2% and investing into something that's giving you 6% return, that delta over there, the margin is 4%, so the leverage becomes a lot more attractive. Just as a simple gauge, you want to keep in mind when you're looking at leverage. You know, leverage is not all bad. It can be bad if you don't manage it properly. That's it.
Perfect.
Good night, guys.
Thank you so much. Bye-bye.